Retail investors, apes, watch this video closely because your money, the one that you invested 2 years ago, might be only worth 80% thanks to the new inflation report, and that is compounded onto perhaps the next Black Monday. I want you guys to know exactly why the Black Monday occurred all those years ago, about 100 years ago, and why exactly are large institutions, large players in the market now buckling down for big changes, especially a PFOF alternative that Apex Clearing Corporation is readying. Also, if we can get to it, 3 things that you didn't know about the SEC chair and exactly why he might be incentivized against us. If you guys like these topics, if you guys want to know exactly what's going to come on the chopping block for Monday, then you make sure that you've already slapped that like button, because that is the best way to keep up and stay up to all of the retail investors looking at this video. Make sure to comment out which like you guys are all the way up to 1600 and watch until the end. First things first, let's take a look at why Black Monday is back on the menu. A list of warning signs is growing on a daily basis. The CPI inflation is slowly ramping up. On Friday, MBS already went no bid, which should remind everyone of 2008, and now crypto is not looking good as well. Quite a big BTC drop for the weekend, as well as an ETH bigger dive. So right now we're looking at 2 pretty stable in a certain way, cryptocurrencies now giving us a shine into what could be coming. A little hype text as you guys leave a recap of 1987's Black Monday. On Monday morning, the crash started in Hong Kong. The crash continued throughout all of Asia and all during the Asian trading session as other markets began to feel the aftershocks of the initial crash. The market carnage continued, spreading throughout Europe, and the London market session opened. By the time the US stock market opened, stocks were virtually in free fall. By the end of the day, the DJIA had dropped more than 500 points and the S&P 500 by more than 55 points. So collapse a few institutions, and that causes margin calls, which means that all of the debt, all of the overshorted stocks that we are holding, that means that they likely are in due time for a margin call squeeze, a mixed squeeze, which we have talked about multiple times in this channel. But we haven't talked about Black Monday. So let's go again into, this is the Federal Reserve History.org telling us a little bit about why Black Monday occurred. In the aftermath of the Black Monday events, regulators and economists identified a handful of likely causes. In the preceding years, international investors had become increasingly active in the US markets, accounting for some of the rapid pre-crisis appreciation in stock prices. Sure seems like it, and even if it's not international, it definitely does feel like retail investors and large institutions are 2 different sides of a coin fighting against each other, and PFOF is heavily involved in the middle. In addition, a new product from US investment firms known as portfolio insurance had become very popular. It included extensive use of options and derivatives and accelerated the crash's pace as initial losses led to further rounds of selling. These are gamma waves, can go either direction, but very important in a margin call squeeze, a mixed squeeze that can push the price very, very high. And depending on what are the other positions that someone who has a lot of exposure, a lot of liability in a certain shorted stock, then would have to pay it all back. A number of structural flaws in the market exasperated the Black Monday losses. In the years that followed, regulators would address these structural flaws with reforms. At the time of the crisis, stock, options, and futures markets used different timelines for the clearing and settlement of trades, creating the potential for negative trading account balances and, by extension, forced liquidations. Additionally, securities exchanges had been powerless to intervene in the face of large volume selling and rapid market declines. It ends up being an unstoppable force. They also developed new rules, also known as circuit breakers, allowing exchanges to halt trading temporarily. You guys probably have seen this in instances of exceptionally large price declines. We've seen this when we were tracking all of the stocks live last year. For example, under current rules, the New York Stock Exchange will temporarily halt trading when the S&P 500 stock index declines 7%, 13%, and 20% in order to provide investors the ability to make informed decisions during periods of high market volatility. Basically, hold on, bro. Let's think about this. In the wake of Black Monday episode, risk managers also recalibrated the way they valued options. So, in a statement on October 20th, 1987, Fed Chairman Alan Greenspan said that the Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today that its readiness to serve as a source of liquidity to support the economic and financial system. Behind the scenes, the Fed encouraged banks to continue to lend on their usual terms. Ben Bernanke, writing in 1990, noted that making these loans must have been a money money-losing strategy from the point of view of the banks and the Fed. Otherwise, Fed persuasion would not have been needed, but lending was a good strategy for the preservation of the system as a whole. According to Bernanke, the 10 largest New York banks nearly doubled their lending to securities firms during the week of October 19th, even though discount window borrowings didn't increase themselves. Some experts argue that the Fed's response to Black Monday ushered in a new era of investor confidence in the central bank's ability to calm severe market downturns. Unlike many prior financial crises, the sharp losses stemming from Black Monday were not followed by an economic recession or a banking crisis. Sounds like a financial, the biggest wealth transfer in history at the time, because in some ways, a lot of people who started investing in the very first time, right, ended up losing it. But some people who started investing in the very first time ended up getting in on a major dip when the market crashed. On the other hand, some argue that the Fed's response set a precedent that had the potential to exacerbate moral hazard. Stock markets quickly recovered a majority of their Black Monday losses. In just 2 trading sessions, the DJIA gained back 288 points, or 57% of the total Black Monday downturn. Less than 2 years later, US stock markets surpassed their pre-crash highs. So, are you thinking about 2 years in the future? Are you thinking about where you would be if you started investing at the very bottom of a new Black Monday? Because no matter what, I'm bullish. I'm very bullish. But we need to understand why bigger institutions are moving away from, PFOF, something that has been a, let's say, lubricant in the market for a very long time, but has now caught the crosshairs of Gary Gensler. U.S. Security and Exchange Commission Chair Gary Gensler stated earlier this week the agency's plan is to crack down on PFOF. Scrutiny over the model comes light after last year's meme stock explosion, which pulled back the curtain on many issues of PFOF. I just made a video about it just last week, so if you guys wanted to understand exactly what payment for order flow is, make sure to watch that video and make sure to subscribe while you're there. Hit that notification button because that lets you stay up to date on these excellent data dives. Apex Clearing Corporation is readying itself for a crackdown on payment for order flow. The clearing firm has apparently been reading the writing on the wall for some time now. Thanks to its impressive senses, it now stands to lead a broad shift toward a new method of clearing trades. PFOF has been a hot topic over the last 2 years. The model involves brokerages selling in bulk to market makers. Those market makers then take the trades to a clearinghouse and return the proceeds. Robinhood ended up changing the entire e-trading industry by implementing PFOF and creating fee-free retail trading. Since the company launched its platform, other companies have also implemented PFOF to keep their market share intact. While revolutionary in the grand scheme of retail investing, PFOF is quite controversial. PFOF skeptics argued that the practice violates best execution requirements enforced by the FINRA, Financial Industry Regulatory Authority. Market makers can execute trades in a way that nets more profit for them, rather than executing them in a way that minimizes the bid-ask spread for retail investors. It's kind of like if I had to order something at the restaurant and then the waiters were incentivized based on the tip that I give them, which is just a sub percentage of the total cost of the meal. These critics call the model a kickback for brokerages as well, and they have a reason to label it as such. A significant portion of Robinhood's revenue comes solely billions of dollars from PFOF. PFOF is coming under intense scrutiny, especially following the controversies around the meme stock boom of early 2021. After Robinhood froze trading of certain stocks that many hedge funds were shorting, some accused the company of bending its knees to Citadel. Citadel is a sister company of Citadel LLC, Citadel Securities, a hedge fund that has to spend billions to bail out pure firms that were collapsing as GameStop shares skyrocketed. So, what exactly is the alternative? SEC Chair Gensler talked about SEC's interest in curbing PFOF. He talked about implementing an auction structure for clearing similar to a model that exists in the options market. The changes would be painful for companies that would have to rush to catch up if a model becomes a PFOF replacement. Apex is already leading the charge. It is the company providing the idea to the government body. It's snitching. Apex is a big snitch. Apex clears trades for several sizable brokerages, including SoFi and Webull. It is one of the larger players in the retail trading market, and now it stands to grow its stake as the industry looks out to roll a PFOF alternative. Apex has noticed the scrutiny the PFOF model has come under the last few years. Anticipating aggressive action from the SEC, Apex has been preparing its own solution by way of the auction model. Apex is actually the source that provided the SEC with the idea in the first place. Under the potential new model, clearing firms and market makers alike would compete to buy retail investors' trades. Apex said this model would create greater competition, which would in turn lead to better execution of investor trades. It would cut down on the monopolization of execution and disincentivize poor execution. Apex is ready to roll out this model, giving it a head start if the SEC were to ban or limit the scope of PFOF. Now, all they need is SEC approval. But some things that you probably don't know about the SEC chair, Gary Gensler. What about his mega NFL TV deal? I'm so glad that we got to this part of the video. So make sure that if you guys do get to this part of the video, tell me, what is Gary Gensler's favorite food? If you guys can guess it right, I will select some of you in the description down below. You have to be eligible by following us on Twitter and Instagram. That is at, let me just see if I can find this. That is at Andrew Mo Money. And that is a way to be able to keep up with the Moon Platoon. It's a fun way as well. The former chair of the U.S. Commodity Futures Trading Commission, CFTC, Gary Gensler is a 64-year-old staunch Democrat from Baltimore, Maryland, whose entire career has been spent in finance, both in the private and government sectors. According to the SEC website, Gensler, known as Mr. Clean, at Goldman Sachs, was nominated by President Biden to chair the SEC in February 2021 and was narrowly confirmed in the Senate in a 53-45 vote, which nearly all Republican votes were tallied against Gensler. Following the well-known meme stock frenzy that involved stocks like GameStop and AMC, retail traders were piqued by Gensler's appointment to the SEC in 2021. Piqued indeed. Mr. Clean is speaking at the Piper Sandler Global Exchange and FinTech Conference on Wednesday, where he's expected to detail the 2021 plans to overhaul the way retail investors' orders are routed. Now you have a good understanding of his philosophy. Let's see if you actually know the man. Number 1. Career at Goldman Sachs. Gensler began to work at Goldman in 1979. At the age of 30, he became a partner at the firm, one of the youngest to achieve the coveted status. He spent the 1980s working at the top mergers and acquisitions banker, having assumed responsibility for Goldman's efforts in advising media companies. 2. Gensler's relationship with the NFL. While serving at Goldman, Gensler was the head of a team that captured the then most lucrative deal in television history. According to New York Times archives, in 1990, Gensler secured a $3.6 billion deal with 5 networks, including ESPN and Turner Broadcasting Systems, for the rights to televise games through 1994 that provided each of the 16 teams with $32 million a year, compared to the $17 million each received under the current contract. Okay. So a couple of conflicts of interest in the longer run, but those of which you probably should know. And finally, the relationship with the 2008 financial crisis. Former President Barack Obama nominated Gensler as the chair of the Commodity Future Trading Commission in the wake of 2008 financial crisis. He worked closely with Congress, the Obama administration, and other regulators at the time to transform the murky over-the-counter financial derivatives markets worth around $400 trillion at the time. Gensler also helped implement the Dodd-Frank Wall Street Reform and Consumer Protection Act. So there it is, a couple of thoughts about Gary Gensler, a couple of things that you probably should know if you are to predict what the SEC will do in the future. Thanks to those of you who watched this video to the very end. Thanks to those of you who have already subscribed to the channel and the second channel, where I will be coming out with music for you guys in the very, very near future. Music to be able to tell stories about underclaimed people, about the fact that I am writing a musical. If you guys haven't seen that video yet, please do. I gave away a lot of my 6-figure portfolio on that video. It's called Something Something. I wrote a musical, I composed a musical, and I can't wait to share it with you guys. So thanks to Professor Meatball, and thanks to those of you who watched to this part of the video, and to those of you who have pressed that join button or the Patreon link in the description and got access to a 6-figure portfolio in that way. For now, but not for forever, I will see all of you in the money. Peace.